Although qualifying for a loan and then exactly how much of a loan involves lots of factors and nitty-gritty details and can become fairly tedious and complex to pin down and document, essentially there are three fundamental legs of the stool that everything really comes down to. The first is credit. And basically, do the credit scores and overall credit profile meet the requirements? Are there any major events that must exceed certain seasoning time periods, like with bankruptcies, foreclosures, or short sales? Are there any collections or judgments that need to get paid off, etc.? But basically, given the guidelines for that particular program, which can vary, does the borrower meet the requirements and have an acceptable credit history? So that's number one. The second major leg of the stool involves the assets for down payment and closing costs. And again, these requirements vary by program, but basically, does the borrower have enough funds and from acceptable sources to satisfy these requirements? The third and final leg of the stool is where we often end up fine-tuning the actual loan amount and sales price when we're pre-approving our clients. And that involves ratio analysis. This is what it usually comes down to when people ask, how much can I qualify for? Now, specifically, there are two ratios we calculate, the front and the back ratio. The front ratio is the PITI, which stands for principal and interest, taxes, and insurance escrows, as well as any HOA or condo fees for the property if applicable. And all that is divided by the gross monthly income. Then the back ratio is that same PITI payment added to any other minimum monthly payments as reflected on a credit report, not regular living expenses such as food or clothing, gas, cell phone bill, etc. Actual debts showing up on credit, or say alimony and child support as well, if applicable. Now, we used to put a lot of emphasis on both ratios, but these days it mostly comes down to that second calculation, the back ratio. Again, different loan programs have different ratio limits. And with VA loans, they actually look at a residual income analysis, which means having enough actual net cash left over for living expenses based on your family size and geographic location. But for most loans, they use the back ratio. And with FHA, the limit would run around 55%. VA loans can go much higher, probably into the 60s. And with conventional Fannie Mae and Freddie Mac, conforming loans, you should be okay up to 45%, possibly even 50% case by case. Jumbo loans vary by investor, so you need to be careful, but tend to be tighter overall. So you want to keep it in the 40 to 43% range. All of these loans, with the exception of some jumbos, get run through a computer program we call automated underwriting. And generally speaking, if it makes it through the software, you're looking good, as long as the data is accurate. Keeping in mind that the real approval is issued by an underwriter after doing a full review of the file. But taking a full and accurate application and successfully running it through the automated underwriter is usually sufficient grounds for a pre-approval letter from a loan officer. So I hope that helps shed some light on the major factors involved with qualifying someone for financing. And as always, it's important to have an experienced expert to help guide and advise homeowners in their options and to avoid problems later in the process. Please feel free to reach out to me anytime if you'd like to discuss this or any other topic, and I'd love to speak with you. Have a great day.